What's up, everybody? Welcome back to Young Bucks. We're taking a quick break from staring at the sun to talk about the important matters of money this week. We're going to talk about who should be Uber's new CEO. We're going to talk about a few companies that have been eclipsed, and we're going to talk about money himself. That's right, Floyd Money Mayweather. Hey everybody, welcome to What the Buck, the segment when we talk about the week's news and money-related issues, but obviously we have one really big story that we have to talk about. First things first, let's talk about the Eclipse guys. Sam Frost, talk to us about your Eclipse experience.
The thing that fascinated me the most was, well, we didn't have full totality. We still had like the little slither around the side that just kind of like rotated from the left side down around the bottom to the right side. But the thing that amazed me was, like, this is such a dumb thing to say, but like how much light literally just 3% of the sun was able to produce. Yeah. Like, it did not get dark at all. If anything, it just kind of looked hazy outside, but like it didn't really get that dark. And it was just like, I think technically we had a 97% eclipse, so that left 3% shining. And it was just, it blew my mind how bright that still was.
Yeah, I thought it was, I fall squarely in the fake news camp. We were not at a point or a line of totality. I might or might not have noticed that it was a little bit darker than normal if people hadn't been standing around in the parking lot like a bunch of idiots. But it was unreal. Like, people closed schools for this here in Georgia. That was absurd. Yeah. Pretty ridiculous. Schools let out early or said, oh, buses can't run. Why? Because they might stare at the sun. Like, as a rule of thumb, like, you shouldn't be driving a school bus if you stare at the sun while driving it to begin with. So I don't really see why that had to happen. But the eclipse, big story, lots of economic analysis in terms of the cost of the eclipse economy. Just bizarro. And then the shortage of eclipse glasses, supposedly. We had like 6 or 7 of those things floating around. I didn't even realize we had any. So I don't know. Fake news, big time to me. Not fake news, Apple. Look at that segue, seamless. Looking to get rid of the Touch ID system on the iPhone, so you'll no longer be able to just press that home button. They're going to make you do facial recognition. Ben, I know you got some thoughts on this. Good move, bad move, or just a weird try-hard move?
Well, 3 points. First is that on the Touch ID, I think that this kind of crept up on Apple a little bit. First, the reason is for that is because they had a supply issue on the Touch ID. They were trying to make it built into and make it a full screen display with the Touch ID, and that didn't work out. There is still some possibility they might have a Touch ID perhaps on the back, but as of right now, it looks like the Touch ID on the front is probably not going to be there. Therefore, they're now going to facial recognition. This second point is that facial recognition seems like the next in a line of poor product enhancements, which is designed to make the product simpler, but actually makes the product a little more complicated. For example, last year they took away the headphone jack, and so now you can't listen to music and charge your phone at the same time, and a lot of cars are not built for that as well. So that now you have facial recognition. Third and final point on the facial recognition is, what if you got a haircut, or what if what if you're super sweaty, or what if you just gained a ton of weight, or or what if you just got into a bad accident and now don't look like you used to, and you can't log onto your phone if your phone is still intact. So there are some issues with going to facial recognition. And then finally, of course, you have the issue of privacy. And of course, Apple knows what you look like, but now they're admitting they know what you look like.
Next topic. Unique time in our lives right now. We're going to get to talk about something that Donald Trump said that many people actually agreed with. Kind of weird. Came out last night, gave a speech that many are saying seemed, dare we say, presidential, talking about Afghanistan and the plan for troops. Ben, talk to us a little bit about your interpretation of it and why you're a little bit nervous about the reception to it.
Well, what I don't understand is why people are so positive on it, because once again, he gives no details and talks about how that's a good thing. And for the longest time, giving no details was exactly what everyone berated him on, because they wanted specifics on policies. And now he says, we're not going to bring the troops home, but we're not going to tell you what we actually are going to do. We're going to use a coalition, and we think that they will be supportive of us, but maybe they won't be. I mean, it's just not, the lack of specifics is noticeable. What is a positive, I think, is that Trump almost came across as someone who listens to other people, as crazy as that may sound. So he said, my initial reaction, my instinct, he said, I like to listen to my instincts a lot. He says, my instinct was to just immediately bring all the troops home and think about America first. But after talking and consulting with generals, I decided that it's probably more appropriate to have some more troops and actually finish the job in Afghanistan.
I'd say something that's interesting about that is that was kind of, correct me if I'm wrong, but it's kind of Obama's, like, what he ran on in, like, 2008 or 2012. Yeah, it was like, we're going to, like, he was just like, I'm going to step in, we're going to bring them all home, and then didn't. And so I don't know if he had the same interactions with the generals or whatever, and they said, no, we're going to, it'd be in our best interest to leave them over there. But, like you said, it is kind of good that to hear, like, Trump, it seemed like he actually consulted the experts, listened to the experts, and took their advice. So I do think that is a good sign.
Krebs, you got anything on it? No. So kind of interesting to see how that plays out. I mean, obviously, anytime you're talking about actual American lives and the plan for them, you kind of, I guess, and kind of as Sam alluded to, you almost have to have, it's a show me story. You have to wait, see what actually happens, what comes to fruition. Yeah. So definitely something to keep an eye on.
Can I ask a question? Do y'all think that, I mean, in terms of, like, military and strategy, do you think we need to know, like, the exact details? Like, how much detail is good enough? How much detail is just too much? In terms of, like if I'm planning to attack Ben, I'm not going to sit here and announce, hey, Ben, this is how I'm going to attack you. You know what I'm saying? It's like, do you think that there should be more detail? Or do you think that's just Trump's way of saying, like, I don't really know what we're going to do, but we're going to do something?
I think the reason you give detail is for the families and for the soldiers themselves. I don't think you give detail in order to promote a strategic imperative, because I think it actually discredits from what you're actually trying to do. Because, again, why would you actually tell your opponents what you're going to do? I mean, that's like saying, if you're playing baseball, I'm going to tell you where the pitch is going to go. I mean, you wouldn't do that.
Right. I was going to say, you see that with companies too, like in their conference calls, they talk about strategy, but they don't divulge everything, because then their competitors can kind of come in and kind of, take it. It's kind of similar.
Kind of like with our podcast, we could get together and plan things out better, but we don't want each other to know what we're going to talk about. So it keeps things looser. So last story we have here on What the Buck. It's also a money topic, because we're talking about money. Mayweather, Floyd Mayweather, Conor McGregor, big fight, pay-per-view fight coming up this weekend. Huge expectations in terms of the pay-per-view experience. It's going to be on Showtime, owned by CBS, obviously. They're expecting this thing to do, possibly as much as $500 million in pay-per-view revenue. I know Forbes thinks it could be 530 to 550 for record. The previous record was actually 430 million for Mayweather Pacquiao. Krebs, thoughts on the fight, and also thoughts on these, like, ridiculous pay-per-view numbers?
First on those numbers, I'm really surprised it's that much higher just in 2 years. I mean, you figure in inflation or whatever, but just in 2 years, it's over $100 million higher.
What's crazy is number 3 is like 240.
And you factor in that Manny Pacquiao was in the other one, and there's so many, like, Manny Pacquiao is worldwide, like, he's huge. Like, not to the level that Conor McGregor is, but, I mean, it's crazy. The fight itself, I bought into the hype of the last fight with Manny Pacquiao and Floyd Mayweather, and it was a bad idea. Straight up, it was a boring fight, I thought. Like, Floyd Mayweather is such a defensive boxer, and that's just how he plays. I mean, he wins by decision all the time, and that's probably what's going to happen on this one. So I'm not buying into this hype. But, I mean, I'll obviously watch it because it's such a big deal. I'm also, side note, I'm a huge fan of how Floyd bet so much money on himself to win fights. Yeah. Huge fan of that.
Yeah, I'm all about Floyd in this fight. I think that I agree. He's kind of a tactician. He's a really technical boxer. If there's a chance, though, for him to, like, knock somebody out, it's going to be against someone who's not actually a boxer. So I do think, like, that's at least in play. Hoping that happens to be a little bit more fun than just saying, you know, kind of a ruling, you know, ruled by boxing officials and all that and all the faux controversy that would surely follow. Sam, you got any thoughts?
Yeah, I think it's going to be an interesting fight because, you know, Mayweather is such a defensive boxer. He knows McGregor's going to come after him. It's going to be interesting to see if Mayweather's like, "Hey man, I'm a boxer, you're not," and see if Mayweather changes his game a little bit, or if he keeps doing his same thing, and that is just like, "Good luck touching me," and he just sits there and wins by points. You know, he's just dodge, point, and just touching them, to get the points. And it's going to be interesting because I think McGregor's going to come out. I really think McGregor's strategy is I'm either going to knock Mayweather out, I'm either going to just fall out from exhaustion, or I'm going to get so tired that I just leave myself exposed and Mayweather's going to knock me out at that point. Because I think McGregor knows if it goes to the end, it would be so bad for boxing for McGregor to win that the only way that McGregor's going to win is if he knocks him out. And so I think it'll be a much more exciting fight. It might be shorter than I expect. McGregor might be like, I'm a 3-round type of guy. That's what he does. Granted, there are longer rounds in MMA. But I think it'll be an exciting fight. I think it's going to be something different than Mayweather has seen, maybe. I don't know, because I guess everyone just attacks Mayweather with that. But I don't know. I'm really interested.
Ben, you got any thoughts? Ben hates boxing. That's his take. I don't know if that's true or not. Yeah, he wants to see 2 real boxers. That's all we got. Thanks for being here for the Young Bucks show. This is the end of What the Buck.
Hey everybody, welcome back to Young Bucks and this edition of Power Players, where we handicap the field of potential CEOs for a vacancy. Today, the big story is who's going to replace Trevor Kalanick at Uber as CEO after he was kicked out under not very graceful circumstances. And we have come up with 4 potential candidates which we think are actually reasonable candidates to take over the leadership role at Uber, either on an interim basis or on a permanent basis. And these candidates are former Yahoo CEO and Googler Marissa Mayer, Shark Tank leader and owner of the Dallas Mavericks, Mark Cuban, former GE, General Electric CEO, Jeffrey Immelt, and megalomaniac and owner of an empire in his mind, Elon Musk. And so we've graded these 4 candidates on 4 different categories. How interested would they be actually in the job? What is their relevant experience? How smart are they? And would their personality be a good fit at Uber? And we graded them out of a score of 10. So there's a potential score of 40 for each of these candidates. The winner only got a score of 25. So we're just laying that out there right now. I'll lead off. I'm joined here with Matt Krebsbach. I'm Ben Nye. And I'll lead off with Marissa Mayer. Former Yahoo CEO, former Googler. She knows the digital space. Not sure how great her track record is at Yahoo after she ended up selling it at a much lower valuation than when she joined. However, I do think she would be very interested in the job. I gave her a score of 8 out of 10. She does have some pretty good relevant experience, so you're looking at a 7 there. In terms of innate smarts, her experience kind of contrasts with her education and her career at Google, where she was much vaunted there. So we gave her kind of a middle of the range grade on that. We gave her a 6. And then in terms of personality and how well she would fit at Uber, this is a woman who definitely has a high opinion of herself. And part of the problem at Uber is that we've already had people with high opinion of themselves at the top at the leadership role. So we only gave her a 3. And this equates to a score of 24. Next up, we have Krebs, and he's going to talk about Mark Cuban.
One thing, though, speaking of people that think highly of themselves, I feel like everyone on this list probably thinks very highly of themselves. So starting with Mark Cuban, how interested would he be in the role? Well, I think everyone knows who Mark Cuban is, and obviously he's busy with owning the Dallas Mavericks, and he has his hand in a lot of other things. So I don't think he'd be that interested just from like a time standpoint. I don't know if he'd have that much time to truly manage a $60 billion Uber company. His experience, I think, translates really well, or somewhat well. We average a 5 there. His IQ, same. I was higher than Ben was, but we average a 6. I think he's very intelligent. Ben, I guess, doesn't. And personality, we gave him a 7. I think he would fit that kind of tech-minded CEO that I think Uber needs, and that came out to a 21 as a whole, so a little lower than Marissa Meyer.
Yeah, and one last thing on Mark Cuban is that he does have that kind of cult of personality that could help the brand. Jeff Immelt, he was a former CEO of GE, tried to re-engineer the company, ended up buying a lot of oil and gas assets, which were not very successful because he bought them at the wrong time. How interested would he be? And the reason we have him included on this list is, 1, because he's available, and 2, because he's actually been talked about as a potential CEO. We probably wouldn't have thought of Immelt as a potential CEO of Uber if he hadn't already been bandied about. We give him a 4 on how interested he would be, simply because his skill set doesn't translate and he doesn't want another perceived failure on his list. Experience level, he just doesn't have that much experience in this consumer digital space. I mean, he's building GE aircraft engines, and he's building rigs for oil and gas drilling. He's not doing a lot of space in the consumer, the social networking business or the digital area. So we gave him a 4 on that. In terms of intelligence, if anyone who manages one of the largest companies in the world deserves some credit on intelligence. That said, whether or not he has the right intelligence for this job is to be determined, so we only gave him a 6. And in terms of personality, he doesn't have that engaging personality that you'd like to see. You contrast this with a Mark Cuban, and the difference is quite stark. So we only gave him a 4 on the personality, so we actually gave him an 18 overall in terms of how well he would do as CEO at Uber.
And lastly, we have Elon Musk. How interested would he be? Same type of thing with Mark Cuban. I mean, he's involved in so many things. He has Tesla. He has Solar City, which is now part of Tesla, and SpaceX. I mean, those are huge companies that have a lot going on. But even so, we think, managing Uber and kind of putting that under his portfolio, there's a lot of strategic fits there that I think would make sense. So we give that a 6. Experience, same type of thing. Just that tech focus, that knowledge base kind of meshes well. So we gave that a 7. IQ, he's obviously a very intelligent guy. What he's built from the ground up in Tesla and SpaceX is really phenomenal. So we give that an 8. Personality, we gave a 4. I guess. I don't know. He's just megalomaniac, I guess. So that kind of rounded out to a 25. So that was the highest on the list. So Elon Musk at 25.
So there you have it. Tusk Media and the Young Bucks are calling the next Uber CEO is going to be Elon Musk, just edging out former Yahoo CEO Marissa Meyer.
The practicality of one last thing, the practicality of that is pretty low. I don't know how they would afford $60 billion. Like, they'd have to issue a ton of stock.
Well, when your stock essentially has negative price to earnings, you have some good currency there. So that's it for this segment. Catch us back next time. This has been Power Players.
Hey everybody, welcome to Get Tanked. This is the segment where we stand in front of a fish tank and we talk about different things. I'm Andrew Hall. Joining me today, Ben Nye. This is a special Eclipse edition, much like the rest of the Young Bucks show this week. Today we're talking about companies that have gone through their own eclipses. What we mean by this really is companies that have maybe looked really strong at some point and then almost disappeared. Gone through a rough patch, fallen out of favor of the markets, almost gone off the terrain altogether, and then somehow managed to shine through, come back, and show themselves to have some strength. So the first company that I have that comes to mind, Ben, is Micron. Micron is a position that we've held from time to time here at Narwhal. I think we own a few shares here and there right now. But so Micron, chip maker, the interesting thing on the processing side and what they're creating is that it's a really cyclical business. And so this is a stock that you saw, really in late 2014, trading in the mid 30s, so 34, 35 bucks a share, something like that. Seemed a little bit high, I think for a lot of investors. It seems like it was kind of running away. You had really high demand, but then all of a sudden you had kind of an oligopolistic market. I think oligopolistic is the right word, but you had it really get thrown off by Samsung. Samsung had troubles with their Galaxy phones. They needed ways to drive revenue. Started putting out all these processors out at just like the cheapest possible price imaginable. So they start kind of, messing up with those who are, creating components for data storage and things like that. So Micron really, really took it on the chin, traded down from 34, 35 bucks all the way into the $10 range. So mid 2016, kind of in that $10 range, looked really bleak. I think a lot of people thought, hey, this might be the last we really hear about Micron, at least as a viable investment option. Things start to stabilize in terms of supply and demand, all those things that you learn about in Econ 101. Stock really rallied. It actually hit as high as $32.96 a couple weeks ago, trading around 30 bucks right now. So kind of a turnaround story, one of those that I think is especially cyclical. And when we think about eclipses, it might be really rare that we actually see a total eclipse in the United States, but they tend to happen somewhere, significantly more often. We forget that there's more than just the continental United States. So just kind of a quick recent example of an eclipse stock. Ben, you got any others?
Yeah, one from a little while back, or early 90s really, early to mid 90s, was Apple, of course. Everyone knows the story with Apple, company that wants to integrate software and hardware into a single device and make it available for the consumer market. Well, in the 1990s, the costs were simply too high that normal consumers were not going to come. And so what you had happen was they invested all this money in the software and hardware, and people say, the money's in the software. And so Microsoft really eclipsed Apple during the 1990s. And it wasn't really until the iPod and the return of Steve Jobs, Steve Jobs had been pushed out, when he came back, the price points were low enough that they were able to integrate that software and hardware into a very simple, almost primitive device in the iPod. And of course, the rest is history. They expanded the iPod to the iPhone, to the iPad, and really spawned a whole line of an ecosystem of products. So that's an example of, they had totality. People were legitimately talking about bankruptcy for Apple. That was totality. But they managed to come through that, and the sun is shining brighter than ever now for Apple.
Yeah, and Apple's a great example of a company that, it's almost like kind of you can tell the age of people, at least you used to be able to, by how they view Apple as an investment. I can remember in 2005, 2006, 2007, when I was interning here, actually, talking to other people in the office saying, hey, we should buy Apple. But these were investors who had lived through the 90s with Apple. This company's dead. They're not going to put it all together. It's a niche market. It's not going to actually work out. Meanwhile, you have an entire generation of young investors who hopefully are investing. Hopefully they were buying companies like Apple, who have basically seen the company go on a run from 2006 to where we are now. So it's kind of one of those things where your sentiment on Apple is a lot of times indicative of your actual age. What else you got?
Next up, I have Seagate. So Seagate is another storage play. If Micron's doing the dynamic random access memory, Seagate is building the hard drive. So these are the ones that spin 7,200 times a minute, holds the memory equivalent of 500 DVDs, 160 Blu-rays. The cost per gigabyte has gone down dramatically. Just from 2009 to 2016, your cost per gigabit has gone down from 11 cents to 3 cents per gigabit. So Seagate kind of found themselves in this really tough era of price competition. And meanwhile, you had flash memory, which is solid state. So this is the memory in your iPhone, for instance, which doesn't have one of those hard drives that's spinning 7,200 times. Lasts longer because it has fewer moving pieces. More expensive, but those costs were really coming down, and everyone was saying, well, hard drives are going to be completely obsolete because of that. So Seagate was really in danger of getting eclipsed. Started trading at a very, very low multiple of earnings, throwing off a lot of cash, but it was down about $10, $11 a share. What happens is huge flooding in Thailand, tons of production comes offline, prices actually stabilize, and then coming out of that, not only did Seagate make a ton of money in the aftermath of that, but then they had this huge new growth opportunity in terms of data center. Because in data center, you just want to do things as cheaply as possible. You don't care about it looking good and sleek and fitting into a nice form factor like an iPhone. So now Seagate has this new story that it's working on, and it remains to be seen whether or not Flash ultimately comes into the data center. But for now, you're looking at Seagate having emerged from the darkness.
And the last one we're going to talk about on Eclipse companies is one story that's kind of still unfolding, and that's Walmart. And when we talk about Walmart, we talk about, traditional big box retailers. And if you read any headlines about, retailers, they're under threat from Amazon.com and, really just Amazon. I mean, when we talk about online retailers, the one we're talking about is Amazon. So very much under threat from Amazon. So it kind of remains to be seen. Ben, what are your initial thoughts and where we are with Walmart and how's this play out?
Well, Walmart is trying to go big on digital. They're trying to do buy online, pick up in store, buy online, ship from store. They're trying to do ways where they can compete with Amazon, but it still feels like the darkness is closing in. We're not at that moment where they say, it's possible we are there and have passed it, but it seems like it just continues to get worse for them in terms of how much of a share of the sun Amazon is blocking out. And is this a permanent situation, or does Walmart emerge from it? We've just talked through 3 or 4 examples of companies emerging from it, but Macy's is arguably not. JCPenney's is arguably not. That's my question to you. What will Walmart happen?
Yeah, I tend to think Walmart finds a way to survive, but it's very much hard to picture Walmart being, this staple of the United States economy. The way Walmart was maybe revered in the 80s, 90s, early 2000s is, hey, this will never change, this will never go away. I know a lot of folks who say, oh, I buy companies that I use, things that will never go away, like Coca-Cola and Walmart and these types of companies. I don't think that's going to be the case for Walmart. I think it's going to be under threat and continually under threat. And they've been slow to evolve from the technology standpoint. And I think, in that regard, it's hard to see Walmart returning to what it once was. I don't think the story's totally written on Walmart, but certainly something to keep an eye on. So there you go, folks. Eclipse companies, I'd encourage everybody to take a look at things that you're interested in investing in and kind of view this lens of, hey, what are the real threats? What makes this go away? And even just on the 4 companies that we just mentioned, we've talked about supply and demand issues. We've talked about, the cost of developing something and the scales of efficiency, things like that. We've talked about pricing issues and even literal flooding leading to a company coming back. And we've talked about disruptive companies like Amazon. So all of those things can pose a threat, and there's many other factors that can be a threat to what you have. I would encourage you to put on, your solar glasses, and in the case here, your solar glasses are the glasses that you put on that remind you that you cannot separate risk from reward when investing. So if you want to buy Micron at $10 when it's near that bottom, understand that the reward may be outsized, but so is the risk. Similarly, if you're buying at the $35 level, what's the real reward? How much higher could it go? So keep that in mind, put those glasses on and hold yourself accountable, and don't go blind out there on your investing. Hey everybody, welcome to the Call Out. This is the portion of the show in which we call people out for things that we don't necessarily agree with. Now, obviously, we may be wrong from time to time, but we like to think we're not. That's why we have this very show right here, Young Bucks. I'm Andrew Hall. Today, we're going to be calling out people who use really, really, really trivial and anecdotal pieces of evidence to make big predictions about investments and the stock market itself in particular. And this week, we had a great example of that with the eclipse. I don't know if you guys heard, but there was an eclipse. It's all we've been talking about on this show. It's all people have been talking about on social media, all that good stuff. There was an eclipse. Now, if you walked out our door here in Marietta, Georgia, and went outside, it looked a little bit cloudy. If you stared directly at the sun, it probably hurt your eyes about as much as it always does if you stare directly at the sun. But the eclipse happened. There was a path of totality. We weren't quite on it, but apparently it was pretty wild. Hopefully you guys got to see some of it at least. Nonetheless, that had absolutely nothing to do with investing. And what's wild to me is that so many people thought, well, hey, maybe it does have something to do with investing. If you don't believe me, go to the Google machine real quick and do a quick search that says solar eclipse impact on investing. It's unreal how many articles you can find. I pulled up a couple of them, one that was especially bad, but just a little bit of anecdotal evidence about people using bad anecdotal evidence to make a point about investing futures. This comes from The Independent, and it's got a quote from Mark Taylor, the CEO of Self-Trade. He says, insights into stock market trends often come from quirky places. With company valuations at unusual highs, some are pointing to solar and astral events that are happening in the next months to make worrying predictions. Well, that's pretty interesting. He goes on to make a worrying prediction of his own, citing someone else's data. He says, much is being made of the U.S. of the so-called Great American Solar Eclipse, which takes place on August 21st. Then he cites a study going back to 1900 and 15 different solar eclipses that were visible from America, not total eclipses, but somewhat significant eclipses nonetheless. And he found that just 13% of the days before an eclipse experienced a positive return. So if you want to break that down, what's he mean? He means, hey, if there's an eclipse coming, there's only a 13% chance that the day before that eclipse, the stock market goes up. That means absolutely nothing to me. He's talking about 15 individual days over the last 117 years. That's incredibly insignificant data. Some more reliable stuff that you might find comes from actually the Federal Reserve. They have the Fred blog, which is not quite as much fun as it might sound like, but it's the Federal Reserve Economic Data blog. And they make an observation that says, at least for annual variety, there's not much to write home about regarding the stock market and solar eclipses. Yeah, that's a pretty obvious point. They've actually got a great graph that shows what the weekly return is during weeks in which there's been a solar eclipse, at least in recent memory. It's just ridiculous, and it's unreal how many people actually had serious opinions about how this solar eclipse was going to crash the market. Things like that. There's another article from U.S. News and World Report. They took a break from ranking which colleges drink the most beer and things like that. Very important work, doing the Lord's work. They took a break from that and talked with Ryan Dietrich, a senior market strategist at LPL Financial. And Ryan observed, this is really poignant, should you ever invest based on the solar system? The fact that we're actually having this conversation is ridiculous. But to Dietrich's credit, he says absolutely not, as things like fundamentals, valuations, and technicals are still what will drive market. Thank goodness cooler heads prevailed. We're not in a total doomsday scenario after that eclipse. Hopefully everybody's still able to see clearly, all that good stuff. The market is still the market, and it has absolutely nothing to do with eclipses. Be leery of this. This is just one example of it. People have all kinds of crazy theories. You know, oh, when the AFC wins the Super Bowl, this happens. When the NFC wins the Super Bowl, that happens. Oh, when presidents are elected, this is what happens. That stuff's all bogus. Look at the companies you're investing in. Get a feel for it. Study economic data. Pay attention to the facts, not the weird, bizarre theories about the moon and the sun and your portfolio.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.